Good morning, friends. It's a beautiful Thursday, July 15th, at 7 a.m. here where I am in beautiful Wyoming. I'm in this tiny little town called Dayton, sitting here looking out my window, watching the deer feed in the field. It's gorgeous. Hey, listen, I said I was going to drop the podcast every morning by 7 o'clock, and I figure, hey, that's going to always be true because it's going to be 7 o'clock somewhere, right? Someone pointed out that I should probably mention which time zone I'm talking about. But listen, hey, it's 7 o'clock where I am right now, so this thing's going to go down for all of you out there in California on the West Coast. Anyway, yeah, 7 o'clock, 7-ish. I don't know. It depends on what time zone I'm in. All right? Right now I'm in the General Mountain time zone, so we're good. All right, let's jump into the Daily Morning Brew, the Block Thrasher Daily Morning Brew. Everything you need to know about crypto. We're brewing up the hottest news of the day. Today, there's not that much, and I tell you what, this might be a day that you might not want to look at your portfolio. Things are a little bit painful. I'm not bad. We're down 1.7% on the total market cap to 1.35 trillion. Bitcoin's dominance is holding steady at 44.1, and the Ethereum gas fees are dropping a little bit. We're at 34 HwAYB per standard. Bitcoin is currently $31,792, down 2.2% in the last 24 hours. Ethereum down about the same, down 2.5% to 1,900. Binance is actually up in the last 24 hours, but still down pretty badly on the week, 5.7% for the week. It is currently 309. Cardano is $1.22, and we've got some great Cardano news today. Pretty much that's all we've got, except for one attack and or possible rug pull. Although in this case, I think it's probably a legitimate attack, and I'll tell you the reason why. XRP is 59 cents. Dogecoin is 19 cents. Polkadot 1301. Binance. That's the USD. Never mind. That's $1, of course. Uniswap 1709. Bitcoin Cash 448. Litecoin 124.86. And Solana 28.91. Chainlink 1608. The market continues with its seesaw trend up and down, and this is nothing all that significant today. It is red across the board, but nothing to panic about, that's for sure. The Cardano blockchain has successfully upgraded to the Alonzo White. The Alonzo White upgrade, part of the multi-phase process that Cardano is going through. They expect to launch full main chain in September. So that's coming up here really soon. Cardano continuing to just plug away and systematically make those updates that they've been promising. So that's good to see. We're going to see full smart contract functionality on the Cardano blockchain very soon. More news about Cardano. Charles Hoskinson, this is actually quite interesting, has introduced a novel algorithmic stablecoin. That's right. And as you may or may not know, we've definitely seen problems with stablecoins. Stablecoins have the same problem that banks have, in that the question arises: what level of reserve are they actually practicing? Do they have one-to-one when True USD or USDT Tether says that they have $1 for that dollar of Tether? Do they have that dollar in reserve, or do they have 5 cents? Like banks do, or something ridiculous like this. And then this is particularly dangerous within the cryptocurrency space because it's not that big of a market, and it's not unlike everyone can all of a sudden at one point in time sell their Tether off. And if the reserve level isn't set high enough, you got problems. So Charles Hoskinson has created a solution for this, and the team over there at IOHK. Let's look at a little bit about what this is. What are the details here? Introducing DJED. It's going to be called DJED. DJED. Mr. Hoskinson has taken to Twitter to share 4 screenshots of a preprint of an article that describes formally verified crypto-backed pegged algorithmic stablecoin. The new protocol, dubbed DJED, acts like an autonomous bank. This means that pegging to basic fiat currency by buying and selling underlying assets, stablecoins, is ensured. At the same time, the share of cryptocurrency is stored in reserves to hedge against market volatility. The bank also trades reserve currency in order to capitalize itself. As a result of this programmed activity, a reserve ration is greater than 1 in every moment of the protocol's lifetime. Now that's interesting. There's just not enough details here actually to make any kind of verdict regarding this. I will delve into this deeper at some point in time. But I'll tell you what, if it's actually true, here's the thing. The authors of the paper stress that this concept is novel, as the stability claims of their protocol are precisely and mathematically stated and proven. They're claiming that it's proven, and they're claiming that it's proved by 2 different techniques, namely a bonded model checking and interactive theorem proving. But this ends up being true, that it's proven. Just think about the level of reliability here. It could be great. Now, of course, it's the question that pops into my mind though is this another centralized solution? Because when you have a centralized solution like USDC or Tether or BUSD, the third party, the counterparty risk is always the issue there. What if somebody on the inside pulls a rug on that sucker? And we have an example of that today, a possible example of that today, which is Bondly Finance. So apparently, an attacker has minted 373 million Bondly tokens. Bondly posted this on their Twitter feed and said, "Attention, Bondly community. Unfortunately, we have been compromised by an unknown party. We would like to take this time to advise you to stop trading Bondly. Rest assured, we have already taken action and will be operating as usual ASAP." So there's 2 ways that this can happen. I'll tell you what, this is one of the things that this whole NFT, DFT, this DeFi scene in the Ethereum world, I think it's seriously losing steam, largely because of these types of things. People are just losing faith in the whole system, and the reason is because there's 2 ways that this could have gone down with this Bondly project, which, by the way, I don't think was a rug pull. And I'll tell you the reason why I don't think it's a rug pull is because the CEO of Bondly is a well-known figure, publicly known figure. It's not like this isn't an anonymous project. This guy has been on podcast after podcast, even partnered with Cardano, and it's known who he is. So if it was an inside job, this is one situation in which there could be prosecution and other types of things like that. So there's 2 possibilities of how this went down. Either number 1 was a rug pull, somebody on the inside, minted these coins, and then what was done was whoever had these coins, the 373 million Bondly, went and just sold them on the market, just into the liquidity pools, just dumped them, drove the price of Bondly down 82%. The other way that this can happen is if the private key, so here's the thing that happens with Ethereum. When a coin is minted on Ethereum, a smart contract is created, and that smart contract is tied to a wallet with a private key. And if that private key is compromised, whoever gets that private key, if they have the knowledge, can go in, alter the smart contract, and mint new coins. So that's the problem with Ethereum tokens, is in theory they have unlimited supply, and it's not like with Bitcoin or with Cardano or some of the others where it would take massive effort to do this sort of thing and to change the amount of the supply and to mint new tokens. One person who gets access to that private key can do it, and that's the danger there. And so that's why there's such a high level of risk. And some of these, Bondly being an example, have been incredibly profitable at times. Bondly was selling for 6 cents, 3 cents, 12 cents. You could get it. Then it went up to 50 plus cents. But now it's down at a cent. I don't know what it is currently. I'd have to look because I haven't checked in just a little bit. But it is down 80%. So it's pretty much currently at this moment worthless. We'll see if they'll be able to pull out of this or not. Probably, most likely, not. Trying to look up here and see if I can get a price on Bondly really quickly here. Yeah, 2 cents. So it's up 50% in the last couple hours because it was down at close to 1 cent. It's only down 59% at the moment. Well, if I had to guess, this team, the Bondly also, they've partnered with a bunch of celebrities and well-known people. So if it, this probably was a hack, and hopefully they come up with a resolution for it, and maybe they will. Maybe what they'll be able to do is just do another airdrop to holders or something like that to I don't know. We'll see what they do. Keep an eye on that. All right, moving on. Let's not wrap up, but continue on with our discussion on inflation, the insidious hedge. We've been talking about that. Today, we're going to just spend a couple of minutes, maybe 5 minutes here on we're talking about the things that the Federal Reserve can do, the central bank can do to try to either increase inflation, which is a stated objective of theirs, 2-3-4%, or stem the tide of inflation when it gets out of control. One of the things they can do is open market operations. Central banks, such as the Federal Reserve, the Fed, also influence interest rates by conducting open market operations, where they buy and sell government or privately issued securities, which means corporate bonds, on the open market. Did you know that? So they can buy government or privately issued securities, bonds, on the open market. So they can essentially, with their unlimited resources, support the companies that they want to support by buying those privately issued bonds. These operations create artificial supply or demand that drives interest rates towards its target. When the Fed wants to increase the money supply and drive economic growth, it credits its member banks' balance sheets with funds in exchange for U.S. Treasuries and other securities sold in the open market. However, the Fed doesn't physically exchange capital with its member banks. The ECB similarly controls interest rates through the European Overnight Index Average, EONIA, the average overnight reference rate for which European banks lend to one another in euros. These purchases and balance sheet credits mean that banks now have more money on hand to lend out to customers at a low interest rate, thus increasing the circulating money supply. Most importantly, this new money provides cheap credit to individuals and businesses who can use the newly acquired debt to make purchases or investments. If the economy is expanding at an unsustainable rate, the Fed will reduce the money supply by selling treasury bonds from its account on the open market, and will raise interest rates. Fewer dollars and higher interest rates means it's more costly to borrow, and the incentive to save is greater. In both instances, the Fed has in-house traders who constantly adjust the bank's securities and credit daily to keep the federal funds rate in line with its target. So it's like a game, basically, that's being played here. Like this big, gigantic, super complicated and convoluted video game with the controllers of the Federal Reserve pulling the levers, right? Pressing A, pressing B, increasing, decreasing. So that's one operation. The one method of influence is the open market operations. Another is quantitative easing, which is actually that's part of the open market. There's a selling of bonds and the altering of and purchasing of bonds and altering of the interest rates. And then there's quantitative easing. When open market operations fail, central banks will specifically purchase long-term government bonds from member banks and reinvest proceeds back into the same securities, or what is known as quantitative easing, QE. This unconventional monetary policy tool spurs economic growth by injecting money into the economy through asset purchases. Conversely, central banks conduct quantitative tightening, QT, to reduce the central bank's balance sheet by slowing the pace of reinvestment of proceeds from maturing bonds. In both cases, the goal is to influence economic growth by altering the money supply. So far from free market movement. There's so much. Call it manipulation if you want, call it control if you want, call it influence, call it whatever you want to call it. If you think it's positive and you call it benefit, come up with a positive term for it. Stewardship of the economy. I'm sure that's... The Fed recently took unprecedented stimulus relief action in response to COVID-19 via aggressive open market operations and QE. Among other stimulus efforts, the Fed's QE strategy in March 2020 was to buy at least $500 billion in Treasury securities and $200 billion in government-guaranteed mortgage-backed securities over the coming month. Wow! Does that not sound a lot like 2008? The entire 2008 great financial crisis, 2008, 2009, was caused by the prime mortgage lending issues and the mortgage-backed securities, and they're doing it again, which obviously drives up real estate prices. The Fed indefinitely expanded the QE strategy a week later, noting that it would buy long-term securities in the amounts needed to support smooth market functioning and effective transmission of monetary policy to broader financial conditions. Though the operations were successful through May, the central bank announced it would begin buying $80 million per month in treasury bonds and $40 billion in residential and commercial mortgage-backed securities in early June 2020. $40 billion a month in residential and commercial mortgage-backed securities. Since March 2020, the Fed's balance sheet has exploded nearly 2 times its size to around $8 trillion due to its massive purchasing efforts on the open market. Here's a chart that, if you can't see, I'll describe to you for those who are not on video. The total amount of assets on the Fed's balance sheet. You can see there was this massive spike in 2008 during the great financial crisis where it went from 1 trillion to just over 2 trillion, probably about 2.2. Then it started to stabilize a little bit, but continued to climb. By 2012, we're looking at 3 trillion. By 2014, from 2013 to 2014, we saw another significant increase. It wasn't a straight up, but it was a steady increase up to about 4.5 trillion. Then we flattened off through 2014, 15, 16, 17, 18. Interesting. Down into 2020. Well, interesting. During the Trump administration, we started to go down. The balance sheet actually started to drop down, dropped below 4 trillion right before 2020. Then the COVID pandemic hit, right? COVID pandemic hits and boom, straight up. 1, 2, $3 trillion up to $7 trillion, right? We've got the election and everything. We had a little drop below 7 trillion for a second and started this steep incline back up again. And now we're just about to touch $8 trillion on the total balance sheet on the Federal Reserve. When it comes to QE, the ECB lends money to governments, and if the ECB being the European Central Bank, it lends money to governments and commercial banks in the Eurozone on a short-term basis, usually 3 months. This method is different from how the Federal Reserve purchases long-dated treasury bonds. For example, the Fed implemented aggressive quantitative easing in the 2008 recession, while the ECB intermittently increased the maturity of its bank loans from 3 months to 3 years. The ECB also eased requirements on its loans collateral multiple times, giving European banks easier access to the ECB's reserve money as they were made available on a full allotment basis. Banks have unlimited access to central banks' liquidity. However, it appears the central banks are starting to converge on their crisis management strategies as the ECB introduced QE in March 2015. And these are this is what you trying to buy a house out there right now, and especially in rapidly growing areas here in the United States on the West, where people are because of the pandemic and other reasons seeking to get out of California, get out of bigger cities and move to more rural locations. Everything's just gone nuts in the housing market. Well, there's that, but there's also this whole QE thing going on, pumping money. Repurchase agreement, repo operations, another method or tool they have. A repurchase agreement, repo, is where a central bank sells short-term securities to investors, typically overnight, and repurchases them the following day or week at a slight premium. Isn't it brilliant? I'm going to sell this to you and I'm going to buy it back from you tomorrow for more. The implicit overnight interest rate. The central bank effectively borrows and the other party is lending at the implicit overnight interest rate. This operation is known as a repo to the seller and a reverse repo for the buyer. The most recent example of repo operations was in response to the COVID-19 pandemic, as the ECB set up a Eurosystem repo facility in June 2020 to provide euro liquidity to non-Eurozone central banks. This system allowed the ECB to arrange repo lines with several non-European Eurozone central banks, including Hungary, Albania, and Serbia, to conduct more repos. These repo lines allow the ECB to better address euro liquidity shortages in non-Eurozone countries by lending euros to these foreign central banks. As a result, the ECB mitigates downward pressure on Eurozone markets and economies that might adversely impact the implementation of monetary policy. So there you have it. And I'll conclude with that today. Wow. It's so convoluted and so messed up, and it's so risky and so just it's it works until it doesn't work, and it goes on behind the scenes, and most of the time we don't even realize that all this stuff is happening, but so much is going on. It's so important for us within the cryptocurrency space to understand all of this, because it has major ramifications on those assets. All right, I hope you have a phenomenal Thursday. We're getting closer to the end of the week here. That's exciting. Thank you for tuning in, and I will talk to you tomorrow. Press on, friends. Love and appreciate you all. Bye now.